Good afternoon. George Cavaligos for HFT Bonds and Notes. Just heard some guy on TV say the markets were generally unsettled today. Man, when I woke up this morning, I looked at my screen, everything was down big. And I was just like, okay, here we are in that game again where bonds and notes are going to be going down until you reach like that panic point where, the stock market or the currencies are moving around a lot. And all of a sudden everybody goes, wait a minute, I got to put my money somewhere for safety, and then the bonds turned around and reversed hard. I was actually long real early this morning because we traded down to, I think the low in the 10-year was 08 plus, and I had 09 plus as a big C equals A target on the daily charts. Got a little bit long, and the market went down to 03 plus and stopped me out for my first loser of the day. I think I got to stop putting trades on until we get the markets open at least 6:30 Chicago time-ish when New York's coming in, and we'll get a better handle and better liquidity. I tried that trade. Actually, I think it was a winner for a little while, and then it turned into a nasty loser. And then it took me a while, but we got back into the game, and I've been trading them from the long side. The curve was kind of a tell early. We saw even when the market was down, the yield curve was flattening, and that's usually, not always, usually a bullish sign. So I was kind of leaning, looking for buy signals. And we got a couple of them in there this morning, actually. And then when the equities opened up under a lot of pressure and sold off, we really got the nice rally going here. Might have been some asset allocation type trades where the big real money guys come in and sell some equities and buy some bonds. The 3-year auction went really poorly. The market sold off, but it held pretty good support levels. Actually, the bonds did a perfect symmetry off of the highs before the auction down to 138.21. Those equal swing trades, C equals A, beautiful symmetry. And it was a great low-risk reward trade for us that kind of turned the day around for us today. So I think you want to be looking for dips to buy. Tomorrow's the 10-year auction. What goes on in Japan again? The yen's up 300 right now. The yen goes up 300, the bond should be up a point. We're up almost a point. Probably should have been up more. And I think if the damage hadn't been done overnight, we probably would have been up more. All right, moving on. Tomorrow's the 10-year. We also have a Fed buyback. I think we're going to have to navigate that little, window again, and I'm going to try and look for some kind of a dip in the bond market tonight. That 138.20 to 24 area would be a great spot. 128.14-ish in the notes, somewhere around there, a couple ticks either way. Definitely got to widen your stops out, and you got to watch the yen again. Even though that didn't work last night. I wasn't trading last night because things weren't working. I should have realized that the yen was trading higher and the bonds weren't, that we were going to have some issues in the bond market overnight. And I think our London hedge fund guys who've gotten long again obviously got stopped out this morning and took me with them on the first trade. So, all right, going forward, I think today's reversal was pretty important. We did see 5 waves down off of last Thursday's highs in the bonds and notes. And I think we're going to try and recover a good portion of that sell-off. We got up to the previous 4th wave highs around 139.27 in the bonds. And we're kind of a little bit short on the notes. The high there would have been 129.05 plus. So that's kind of an objective I have in mind. I'd like to see us go and test that 129.05 plus level in the 10-year. And I think we could see the bonds go up a little bit more here. Actually, the high is 138.23. 138.27 was that previous 4th wave high. I think we'll see that. What I want to see is where the dip goes, and I want to try and buy the dip, obviously. That's my plan. We'll see what happens. Got to be careful out there. Part of the yen rally this afternoon was a story floated out of Japan that one of the regulators is going to, in the spring of next year, implement a plan whereby investors, I wasn't real clear on this, whether it was investors or equity holders. Is it the stockholders and the bond holders that are going to get whacked, or is it the people that have deposits at the bank, are they going to get whacked like they did in Cyprus a couple months ago? I don't think that's a real good idea. If they're going to whack the bondholders and the stockholders, that's the way the system's supposed to work. You know, the taxpayers aren't supposed to bail these banks out. The guys that invested in the stock, the guys that invested in the bonds, they're the guys that are supposed to lose out, and the managements. Instead, we have these bailouts where the management gets rewarded, the bondholders get most, if not all, their money back, and the stockholders, you know, whatever happens to them, no one cares. They end up usually losing quite a bit. But everybody that invests in these firms are the ones that are supposed to lose out, including the management, and not get bailed out and not get big bonuses. The system is supposed to reward winners and provide some type of penalty to the losers. And we've done away with that, and it's a bad idea because it prompts these banks and these people to make these big risky bets, and they know that if they make a mistake, they're just going to get bailed out, so there's no damage to it. If there was real risks involved and they knew it, like Dodd-Frank is supposed to do, but I don't think really does, these guys would be a lot more careful with what they invest in. Moving on. The other idea of taking money from people that have deposits at these banks like they did in Cyprus, that's a bad idea. Depositors are supposed to be somewhat careful about where they put their monies, but they shouldn't be the ones that are paying the penalty for the mistakes made by the management. It's wrong, it's not right, and it prompts a lot of what do they call it, moral hazard and unintended consequences that will continue to reverberate and are still reverberating through the markets today. Kind of like QE. You know, it's going to cause unintended consequences at some point. Maybe it's starting. These currency wars always end badly. Please read your history, everybody. Thank you. Have a great night, everybody.